input costs, let's also talk about how in the start of the show we talked about crude prices, keeping up with that conversation. Let's get you some more insights when it comes to this. In fact, my colleague Piyush spoke to Moody's ratings to try and understand what their warning is. They're warning the ongoing West Asia conflict is going to be creating risks when it comes to Indian banks, and that's going to be through elevated crude prices, as you can see on your screens as well, about a 2% uptick coming in. When it comes to Brent prices, let's put all of this into perspective and listen into a slice of that conversation.
Today we have with us Alka Anbarasu. She is the Associate MD of Financial Institution Group at Moody's Rating. We also have Mr. Karthik Srinivasan, the Group Head of Financial Sector Rating at ICRA. Thank you both spokesperson for joining us today. I want to start with Alka. If you could give us some color on what you are sensing, the risk that this particular West Asia conflict poses to Indian banks.
Thank you for having us on the show. Just to frame the discussion, at Moody's Rating, our house view is that, or our central scenario is that we expect the conflict would be more prolonged than at least what we were anticipating a month ago. In terms of our central scenario, we expect no lasting damage to any infrastructure in the Middle East. Having said that, because of the supply chain bottleneck, we expect oil prices would range somewhere between $90 to $110 a barrel throughout the year. And in terms of the impact that we expect for financial system and particularly Indian banks, we expect the impact would be of a second order impact. One, via the macroeconomic channels because of, say, a moderation in economic growth, higher inflation and higher interest rates, but also via some of the borrower channels in the vulnerable sectors where we do expect some uptake in asset quality or NPL ratios for the Indian banks. Having said that, the banks are entering this part of the cycle with fairly healthy buffers, capital and profitability, and therefore we expect that their capacity to withstand the impact is quite strong.
We are aware that this second and third round order from the West Asia conflict, essentially this poses upside risk to inflation. Do you feel that India's banking regulator, the RBI, is likely to come in and is there a possibility of a rate hike in this calendar year or in this financial year?
Yeah, sure. On the rate side, we do see there's more upward bias, and clearly the topic of rate declines is perhaps a thing of the past. If we were to just zoom out, even globally, whether it's the dollar yields that have been inching up, but even regulators in Asia Pacific, whether it's Australia, Philippines, and even Singapore, have tightened monetary policy. And indeed, for India as well, we expect that there could be some rate hikes by the RBI during the year.
We also are aware that ECL guidelines are to be implemented, and this will change the whole model. Banks recognize their stressed loans. What would be the impact on banking sector's balance sheet because of the new ECL norms?
Actually, this ECL norms implementation has been in discussion for a fairly long time. It's now that the RBI said that they will be implementable from next financial year. And you also have a glide path in case you want to take the transition to the entire thing. Our assessment at this stage is most of the banks are fairly comfortable with it. And if one was to assume that the majority of the banks would possibly entirely take the knock at the first instance, the overall impact on the capital may not be more than 150 basis points, which in the current context, most of the Indian banks, be it public or private sector, are fairly well capitalized, so it should not be too much of a challenge. And yes, there could be some banks who may want to take a little bit of forbearance, but at a system level, I think it should be manageable for the banking system at large.
Now, bankers have guided for a double-digit growth in credit for FY27. Alka mentioned how there is a possibility of monetary policy tightening going ahead. In case of a rate hike, how do you see the bank's margins, net interest margins playing out? What would be the trajectory from here on?
In terms of margin, clearly there is pressure on banks' margin, and this is already because of higher rates, but also because there is a fair bit of competition for deposits as well in the market, and this deposit competition is also leading to higher borrowing costs or higher funding costs for the banking system. On the lending front, while we do expect banks will pass on if there is a rate hike to their borrowers, the rate transmission does take some time. So on the net interest margin, we do think that there would be some moderation for the banking sector NIMs, but again, we're talking about moderation by perhaps 10 to 20 bps and not a huge contraction in margins for the system.
Thank you for those insightful comments. Back to studio.
So there you go. That's the word coming into Moody's in terms of crude prices being seen at $90 to $110 per barrel and supply chain bottlenecks that you should also be looking at intensifying. That's all the time that we have on this edition of Lunchtime Trades. Thank you so much for tuning in.